People often talk about crypto like it's a lottery, something where a few lucky people got rich while everyone else lost. But that's not the full story. The people who made serious money from crypto didn't win by accident. They noticed an opportunity before most people were paying attention. When Bitcoin first appeared, it didn't look impressive. There were no ads, no big companies, and no governments supporting it. It was just a digital idea shared online. Most people ignored it, some laughed at it. Only a small group became curious. They didn't know Bitcoin would one day be worth thousands of dollars. What they understood was simpler. If a digital, borderless form of money actually worked, it could matter. Those early users bought Bitcoin cheaply. Some mined it on their personal computers. Others earned it through small online jobs or simple trades. For a long time, nothing dramatic happened. Prices moved slowly and interest stayed low. Many people lost patience and left. Then, everything changed. As Bitcoin started rising, attention followed. Media outlets began talking about it. New investors entered the market. Prices accelerated faster than anyone expected. The same pattern repeated with Ethereum and other cryptocurrencies. People who bought early and held through fear saw returns that traditional markets almost never offer. But not everyone succeeded. Many entered late, driven by hype and emotion. They bought when prices were high and sold when prices fell. Crypto rewarded patience and punished impulsive behavior. This is the first real lesson of crypto. It doesn't make everyone rich. It rewards people who understand risk, timing, and self-control. And this is only the beginning of the story.
Crypto is often described as digital money, but that definition is too simple. At its core, crypto is a system that allows people to transfer value without needing a bank, a government, or a central authority. Instead of trusting an institution, users trust mathematics and code. This system is powered by something called a blockchain. A blockchain is a public digital ledger where every transaction is recorded. Once a transaction is added, it cannot be changed or deleted. This creates transparency and security at the same time. Anyone can verify transactions, but no one can manipulate them. That is what makes crypto different from traditional money. With banks, you trust the institution to keep records honestly. With crypto, the records are shared across thousands of computers around the world. No single entity is in control. Bitcoin was the first successful example of this idea. It showed that digital money could exist without a central authority. Ethereum expanded this concept by allowing not just money, but programs and agreements to run on the blockchain. These are called smart contracts. They execute automatically when conditions are met, without middlemen. This is why people say crypto is not just money, but a new financial infrastructure. It removes friction, reduces dependency on trust, and opens access to anyone with an internet connection. This fundamental shift is what attracted developers, investors, and eventually the entire world.
Crypto may sound complex, but buying and selling it is actually simpler than most people expect. The process usually starts with choosing a cryptocurrency exchange. An exchange is a digital platform where users can convert traditional money into crypto and back again. After creating an account, users are asked to verify their identity. This step exists to prevent fraud and comply with regulations. Once verification is complete, money can be transferred from a bank account to the exchange. With funds available, users can choose which cryptocurrency to buy. Bitcoin and Ethereum are the most common starting points, but many others are available. One important detail is that users do not need to buy a full coin. Crypto can be purchased in small fractions, which makes it accessible to almost anyone. Selling works in the same way, but in reverse. When prices rise, users can sell their crypto back into cash and withdraw it to their bank account. The biggest challenge in this process is not the technical side, but the psychological one. Many people buy based on excitement and sell based on fear. They enter the market when prices are already high and panic when prices fall. Successful investors usually do the opposite. They make decisions before emotions take over. They understand that volatility is normal in crypto. Prices move fast, both up and down. That volatility is what creates opportunity, but it is also what causes most losses. Knowing how to buy and sell is easy. Knowing when to buy and sell is what separates success from failure.
Crypto is often criticized by people who ask a simple question: what is it actually used for? The truth is that cryptocurrency has many real use cases beyond speculation. One of the most important uses is value storage. Bitcoin, for example, is often compared to digital gold. Its supply is limited, meaning there will never be more than a fixed number of coins. This scarcity makes it attractive to people who want to protect their wealth from inflation and currency devaluation. Another major use of crypto is global money transfer. With cryptocurrency, value can be sent across the world in minutes without relying on banks or payment companies. There are no business hours, no borders, and often lower fees. This is especially important in countries where traditional banking systems are slow, expensive, or unreliable. Crypto also enables decentralized finance, often called DeFi. This allows people to lend, borrow, earn interest, and trade without intermediaries. Smart contracts make these systems run automatically, reducing the need for trust. Beyond finance, crypto is used in digital ownership through NFTs, gaming economies, and online identities. These applications show that crypto is not just a speculative asset. It is a technology that is slowly changing how value, ownership, and access work on the internet.
Crypto can create opportunity, but it also carries real risk, and this is the part many people choose to ignore. Prices can rise fast, but they can fall just as quickly, sometimes within minutes. This volatility is not a flaw in the system, it is part of how the market works and how opportunity is created. People who lose money in crypto usually don't lose it because the technology failed or because crypto itself is a scam. They lose it because they enter without understanding risk, without a clear plan, and without patience. Many follow hype on social media, buy what everyone is talking about, and expect instant results with no downside. When the market moves against them, fear takes control, emotions replace logic, and they sell at the worst possible moment. The people who survive and grow in this space think differently. They accept uncertainty as part of the game. They invest only what they can afford to lose without damaging their life. They focus on long-term thinking instead of short-term excitement. They understand that real wealth is built slowly, even in fast and aggressive markets like crypto. Education becomes their strongest tool. Knowing how the system works, why prices move, how cycles repeat, and how human psychology drives markets gives them a real edge. They don't chase every trend, they wait for clarity. Crypto is still evolving. New technologies, new regulations, and new use cases continue to appear every year. This means the opportunity is still here, but it belongs to those who are willing to learn continuously, adapt when conditions change, and stay disciplined when emotions try to take over. If you want to understand crypto beyond headlines and hype, if you want to learn how people actually protect and grow their money in this space instead of losing it, then stay with this channel. Watch the next videos, build real knowledge step by step, and remember this: in crypto, information is not just power, it is survival.